we've got this massive fiscal overdose. You've got a huge fiscal and monetary stimulus coming from China. We've got tensions in the Middle East with oil prices. The probability of a really sharp bounce in inflation, I think, is almost certain. The fiscal and monetary response to COVID plus the banking crisis of 2023 has been over $16 trillion. If the Fed stays higher for longer to try to kill inflation, interest costs are $1.1 trillion a year, up from $250 billion. Let me tell you something. The probability of Israel hitting Iran's oil facilities, I think, is 100%.
Hi, and welcome to Wealthion. I'm James Conner. One of the things we try to do here at Wealthion is educate you on the financial markets. And if you are seeking additional help with regard to the markets and your financial future, check out wealthion.com/free. Wealthion will put you in touch with a vetted financial advisor to examine your options. Once again, that's wealthion.com/free. Now on to the show. Larry, thank you very much for joining us today. How are things in Panama?
Good. I've been on the road. Just got back from Geneva, Zurich, and New York City. So it's been quite a road trip.
Now, you are from New York, but you've been in Panama for many years. Why did you make the move to Panama?
Well, my wife and I, we were in New York 15 years with the kids. We have right now we have a 9-year-old and a 10-year-old, and we came down for COVID. Went to the beach. It was a nice place. And then, over time, I noticed more and more of my friends were leaving the city and going to Puerto Rico, Austin, Texas, Florida. I said, we have some family down here. Why not, give Panama a try?
And how is the tax situation? Better than New York?
Oh, yeah, it's quite amazing. It's you get a foreign earned income deduction. Your cost of living, 2 nannies in New York City is about $120,000. In Panama, you can have a staff of 5 or 6 for 50,000-ish. So it's a totally different tax climate and also just overall, cost of living climate. So it's not quite as tax efficient as Puerto Rico, but it's up there.
I'm going to have to check it out sometime. So Larry, for those who might not be familiar with you and with your background, maybe you can provide us with a little bit of history.
Well, I'm a New York Times bestselling author. I'm really proud of that. The first book was A Colossal Failure of Common Sense about the Lehman crash. And it's been called one of the top selling business books in the world. We've sold close to 1 million copies published in 12 different languages. And it is a CFA Institute top 20 book all time. I was a trader at Lehman Brothers, and that book was about, kind of the greatest financial crisis in the history of the world. The next book connects that generation to now. The Lehman crisis was about a $4 trillion fiscal and monetary response. So the Lehman crisis, the crash, the financial crisis, was about a $4 trillion fiscal and monetary response. I made an appearance in the movie called Inside Job, which won the Academy Award. And it was a great movie to be part of. One of the things that we make the point today relative to that period is the fiscal and monetary response to COVID plus the banking crisis of 2023 has been over $16 trillion. And so we're really looking at a whole new regime change in what we call portfolio construction.
Fascinating. And so you've been on the road marketing your new book, How to Listen When Markets Speak. And you've been all through North America, all through Europe. And I'm curious, what sort of feedback are you getting when you speak to individual investors? What are they most concerned about?
Well, we're really fortunate because the thesis of the book comes down to the questions I get the most. It's like, okay, are we really in this multipolar world? And that's one of the main core thesis tracks of the book. So think about from 1968 to 81, it was a multipolar world, more global tensions, and totally different portfolio construction. The power of labor unions were more sustainable, more powerful. So you have a lot more sustainable inflation forces coming out of the Vietnam War. You had a lot of fiscal spending from the Great Society with Johnson. And so the questions that I get, the similarities between, say, 1968 to 81 to now are just off the charts. And, unfortunately, portfolio construction today is really looking backwards. And like, if you look at the average portfolio in America today, the families, everybody's 401k is really designed for a 2010 to 2020 portfolio. And the point that we make in the book is you really need to start thinking about a 1968 to 81 portfolio.
And can you elaborate on that? Why do you think there's similarities between 1968 to 81 and now?
Well, the biggest reason is you can see of late government, government largesse and money printing. The Great Society, we're coming out of that incredible period of what we call fiscal overdose in the 60s with the Vietnam War. Wars always bring out Neil Ferguson. I sat down with Neil Ferguson with the book, and he's probably the most famous financial historian, but he makes the point that, wars are just really typically bring on sustained inflation forces for multiple years. They just don't go away. Obviously, we had COVID, but now we have the labor unions. We have oil prices that are higher because of that multipolar world where you have tensions in the Middle East. Right now, the debate is, not if, but when does Israel strike Iranian oil assets or nuclear power assets or nuclear weapon assets? So it's really a much different world today. And but that's, if you think about the portfolio construction, by the time you got to 1980, 81, say the portfolio, so the S&P 500 was essentially 50%. The S&P 500 construction was 50% energy, materials, and oil and gas. 50%, 50. And when we started to write the book about a year and a half ago, in recent years, we've got down to 12% for those groups.
Well, I guess the one thing that comes to my mind is that the 1970s versus now, there's no comparison. I mean, in the 1970s, you didn't have any of these massive tech companies like Apple, Microsoft, Amazon. You didn't have AI. There's so many sectors that didn't even exist back then. So therefore, there wasn't as many asset classes you could invest in. So of course, there's going to be a much more higher weighting toward energy.
Right, for sure. But the other aspect in the book that we talk about is this whole artificial intelligence. Like, nobody's really doing the math on all the data centers and energy consumption and the amount of copper you're going to need to really build a power grid that's going to sustain all of these extra. I mean, essentially, like potentially a Germany and a France of extra power consumption into the United States, potentially, in terms of all of these data centers. So we talk about nuclear power in the book. We talk about companies like NuScale, companies SMR, small modular reactors, companies like Microsoft and Google. They're going to need their own power sources. And so the trade over the next 10 years is going to be toward infrastructure that's going to have to support all this additional energy demand. And we have a power grid in the United States. It's essentially 50 years old in some spots and 30 years old in others. That's nowhere near strong enough or young enough to really support all of this. What we call is like a lot of bullshit BS when it comes to artificial intelligence. Like, nobody's like, in order to get to where the street's telling us we're going to go, we just don't have the energy infrastructure to support it.
So we've seen a number of transactions here in the last few weeks where a lot of the big tech companies have gotten behind nuclear energy. And I guess the first big one was between Constellation Energy and also Microsoft. And they entered into a 20-year supply agreement. We don't really know the details behind it, but nonetheless, Constellation is going to be supplying energy to Microsoft to run these data centers. And we've seen a number of other companies, Oracle, Amazon, all entered into SMR deals. But I think what you're telling me is you're very bullish on nuclear energy and therefore you're bullish on uranium.
Yes. Oh, for sure. I mean, yeah, it's a high beta sector, which means it moves much more than the market. So you have to be careful. But the entire uranium sector is like $45 billion. I mean, it's not even a rounding. I mean, NVIDIA is $3.5 trillion. That's 3,500 billion. Whereas the entire uranium sector is 45 billion. So it's just not, it's a joke. And it's not just that natural gas. I mean, you've got natural gas companies that are screaming by on a relative value basis relative to technology. So in our bear traps report and in our Discord room, so we run a Bloomberg chat behind us with hedge funds, mutual funds, and pension funds. And so imagine like all the different asset managers in the world. We host a conversation with high level intelligent investors on the professional, the institutional side, and we recap that for the wealth manager and the family office through the bear traps report. And the one trend that we've been seeing over the last like 6-9 months is toward, it's not just uranium, but what types of companies within the uranium sector, what types of companies in natural gas that are going to support, what types of companies in the metals and mining sector that's going to have to support the build out of the copper and the aluminum. That's where we're seeing the institutional investors really start to focus on.
So I'm curious now, when you talk to these institutional investors, what are they saying exactly on the price of uranium? Because it's still down on the year. We've seen a bit of a move here in the last couple of weeks, especially in the stocks, but not so much on the uranium price. What sort of feedback are you getting?
Well, what happens is at the early stages of a commodity bull market, people move into the commodity and not so much the companies behind, like all the mining companies behind it. So you think of like oil and gas in 2020. Everybody moved into oil at 2020, 21. The first step is oil. Then investors moved into Exxon and Chevron, and then it was Marathon, and then it was Devon, and then it was all of the smaller cap companies. And so the uranium price has really kind of out, because it's early stages, people moved into uranium first. And I think some of that money's coming out and moving into the next gens. Obviously, Cameco is a big market cap company that's still gathering much of the international attention because it's the largest market cap company in the space. But I think right now you're seeing some rotation out of uranium and moving into the URNM names.
And I'm curious to hear your thoughts on some of these utility names, like Constellation Energy, for example. It's up 150% on the year. Why has so much money flown into these utility names?
Well, with utilities, you've got like traditional utilities and then companies that capitalize on the overflow of demand. And if you think of like the data centers, if they can't get their own their own energy source, they're going to be coming in and out of inflection points where they're going to be pulling off of different utilities. And there's different parts of the day when there's excess energy versus that. It's the kind of that overflow, and companies that can kind of capture that excess energy and then distribute it, like the constellations of the world, they're going to really benefit from the artificial intelligence build up from the data centers. Whereas a traditional utility that doesn't provide that extra cushion infrastructure of what you need, that kind of gearing that you're going to need above and beyond what the traditional energy system does, the traditional grid, the traditional power. So you have the traditional power of utilities, and then you've got this huge mystery meat of artificial intelligence that is going to come in all these different ways. So you're going to need this buffering system to support the entire energy complex, and that's what some of these companies are capitalizing on.
So we've seen a number of these tech companies enter into nuclear energy. Why don't they just invest in nat gas? It's so plentiful. It's cheap to produce.
We think they will. I mean, the problem with nat gas is getting it from one place to the other. You need a utility to burn the gas. So the thing about SMRs is the small modular reactors is that the lifespan to create them is much shorter than to build a nuclear power plant. So you can see why if you're a Google or a Microsoft, and you're going, you can't wait for your utility to build a nuclear power plant. So you're going to probably invest in those SMRs. With natural gas, we may see some type of localized system where a company that can produce like a smaller utility complex that can support a data center that's up there, but that's still going to be, your natural gas sector is going to be a big beneficiary. We've had a huge glut of natural gas the last couple of years. Antero is one of our favorite names. AR, It's got about a 10% free cash flow yield. They bought back 12%, 10 to 12% of the equity, and they've cleaned up the balance sheet. Those types of companies, when you're going to have all that excess demand for natural gas over the next couple of years, coming from Europe, coming from data centers. So your natural gas price is going to go from 250 to 3 to maybe 350 to 5 over the next 5 years, and that's going to be the Anteros of the world, AR Equity, are going to be a big beneficiary there.
So you're bullish on nat gas. What about oil?
Well, we love oil. The seasonal weakness is spectacular, usually in September, October. So you have a lot of seasonality on the weak side. And then you had this situation over the last couple of months where you had the tensions in the Middle East, you had the fears on the U.S. economy over the last year, you had the fears of China deleveraging. And so there was this massive amount of pressure on the oil sector. And now you're coming into tax loss season. And so, we have a model that tracks the tax loss intensity, typically ends around November 10th to 15th, where it climaxes. And so you want to be buying the Schlumbergers. I mean, if Trump is elected, your Schlumbergers, your drill baby drill complex, your companies that service oil, you can buy Schlumberger on around the 200-week moving average. A 200-week, that's a really interesting place to get involved. You can buy Occidental for below where Buffett bought his last 80 million shares. So Buffett's essentially been buying Occidental, but you're going to have some tax loss selling between, say, right now, October 22nd to November 15th, maybe November 20th. This is, to me, every year we build a basket of tax loss candidates. And this year, your Nikes are in there, your Boeings, and a lot of these energy names, because you're going to have, and remember one thing, in years where you have big gains in the S&P, the tax loss selling is a lot more intense. So right now, CFAs and accountants are calling up their high net worth individual clients, and they're saying, find me a tax loss, because you've got that big gain on NVIDIA. You've got that big gain on the S&P, and you need to find a tax loss to offset it. And so that's what creates this incredible opportunity over the next 6-9 months. And energy, Schlumbergers, the Nikes and the Boeings of the world.
Hi, everyone. I'm one of your hosts here at Wealthion, Andrew Brill. In these weird economic times where the market is up, then it could go down, a lot of people calling for a correction. Some people think it's just going to keep going up. But if you need help being financially resilient, head over to wealthion.com/free, and we'll give you a free, no obligation. We don't expect anything from you. We'll just help you evaluate your portfolio and let you know what we can do to help. Again, head over to wealthion.com/free for a free, no obligation portfolio review, and let us do the heavy lifting for you.
So you made mention of the fact you think nat gas is going to go from $2.50 to $5. Oil's currently trading in the low 70s. Where do you see oil going?
Oh, oil, they have to refill the SPR, right? Trump is going to drill, baby, drill, but right now oil production is still 13.5 million barrels a day, and we were in 2008 just below that. So it's going to take a long time for that oil production to get caught up again, even with the deregulation / oil production boom. And so oil prices in the intermediate term, we're going to come out of this seasonality, which is pretty horrific. Typically in October and September, October, and we're going to come into the new year with a China stimulus plan, potentially a new president of the United States, or even under a Kamala Harris presidency. There's the regulations on the energy production and exploration have been really intense. So some people think, the Kamala Harris regime is even more bullish for energy. The bottom line is Trump will attempt to refill the SPR, the Strategic Petroleum Reserve, and that means we're going to have to, we're going to have a real oil shortage. I think no matter who's president next year, at least for the first half, there's 1 billion people in India that don't have air conditioning. That's one of the lines from our book. We've taken 5 million jobs out of the United States, 5 million jobs. We've exported them around the world. We've raised the standard of living dramatically in India, Bangladesh, all of these emerging market countries. So if you're working in a call center in India, you're making 10 to 40 times more than your great-great-grandparents. And so all of these people are driving mopeds. They're consuming energy at a much greater pace than the previous generations. But at the same time, we've decimated the Rust Belt in the United States. We've taken those 5 million jobs around the world, and we've raised that standard of living. But in terms of the global population, right now, we're up almost 1 billion people over the last 10 years, 1 billion more human beings. It's about 900 million people. So global exploration and what we call capital expenditures for oil and gas we're essentially, based on all the math and all the formulas, we think we're about $3 trillion in deficit in terms of exploration investments in natural resources, in oil and gas, metals, uranium. And so we're a $3 trillion hole. So we've basically suppressed the supply of key natural resources through regulation, through all kinds of things. And we've increased the demand equation dramatically around the world. And so now it's a really energy crisis set up for probably 2025 to 2028.
And I want you to expand on that. When you talk about an energy crisis setup, what exactly are you talking about? Like an explosion in the price of oil? It goes from 70 to 100 or 125 bucks a barrel?
Yeah, well, that's what happens is when oil goes from 70 to 100 to 110, all of a sudden there's certainty within the oil and gas complex. So then companies that do spend capital expenditures can make those investments. So it's like turning around 3 aircraft carriers in the middle of the Atlantic, because you're suppressing through regulation and all kinds of things. You know, we had a commodity boom from 2010 to 2016, 18, even almost 2020 to some extent. But then we really had that commodity crash in 2016. And so we've because of that, all these CFOs of these companies have seen their previous 3 or 4 bosses get shot. And so they're underinvested. That's where we get into that $3 trillion of investment. So if you took, to keep it simple, if you took the 2010 to 2014 trajectory of capital investments in oil and gas, uranium, and metals, if you took that trajectory to today, we're $3 trillion in the hole. But like I said before, from 2014 to today, we're about 1 billion people greater population on the planet, and a lot of that emerging market population, because we've decimated the Rust Belt dramatically, we've raised that standard of living. These people are much more aggressive carbon consumers. So that's the setup for the only way you're going to get enough investment into the commodity complex is if we have a massive 50% increase, 100% increase in oil, gas, and uranium and copper.
The one thing the Biden administration has done very well is they kept the price of oil low. They did the backdoor or backroom deals with the Venezuelans. They did the same thing with the Iranians. So both of these countries are pumping out oil onto the open market, and that's suppressing the price. Are you suggesting that regardless of who comes into power, whether it be Trump or Harris, that they're going to let the price of oil rise? Doing so would not be very political, or would piss off a lot of electorates.
Yes, well, you're 100% right. Like during election years, if you look at oil in the fourth quarter in election years, the price, Republicans and Democrats do whatever they can to keep the prices lower. And then there's kind of an equilibrium move the next year where you've got to somehow, like that strategic petroleum reserve, we're millions and millions of barrels short. And so no matter who's president in the next administration, there's a rebalance, because if Kamala Harris is president, then she's in office for 4 years, and so she's willing in that first year to take some pain and to get that oil production back up. But like you said, the Biden team's done whatever they can to keep oil prices down into the election. Trump will aggressively want to refill the SPR. And so that whole I think regardless, at least for the first year, you're going to have dramatically higher oil prices because we're so far behind the curve in terms of production.
So what does this do to inflation? Okay, let's just assume oil goes from 70 up to $100 a barrel in a short period of time. What does that do to inflation? What's that do to the global economy? And I guess what's that mean to interest rates?
Well, think of like by 1970, 1971, inflation had come down from 6.1, 6.2% down to close to 4. So inflation had come way down. And Arthur Burns was head of the Federal Reserve at that time and had celebrated the demise of inflation. And lo and behold, by 73, 74, we had this multipolar world, tensions in the Middle East. Like I said before, you had a lot more sustained inflation forces. And so you had this rebound in inflation, dramatically higher. So typically, historically, inflation comes in these 1 to 2 to 3 different waves. And so there's the first wave where inflation, the forces get underneath the surface, but then it's underneath the seat cushions. It's deeply embedded in just take labor. Look at labor unions. Look at the port strike. That was now extended until January. But labor unions, look at the deal that just happened with Boeing. I mean, they're paying 35, 40% more. And so when you're a labor union leader, you're dealing from strength because your union ranks are a lot more motivated to aggressively ask for higher income and higher compensation per hour because they're coming home from work every day with this incredibly nasty inflation. And so all of these forces are coming together where we're going to have that second wave, just like we had from 1968 to 70. We had an inflation move. The Fed hiked rates. They lowered inflation. And then from 70 to 73, 74. Now, that was a lot worse because we had a real crisis in the Middle East. But let me tell you something. The probability of Israel hitting Iran's oil facilities, I think, is 100% because Hamas and Hezbollah are funded by the oil. And so, and all of those rockets that you see raining down on Israel and all of that, all of those resources really come from the oil money. And so you don't really get, I think if you listen to, we hosted a call this week with institutional investors, and if you really don't get an end to the war in the Middle East without really ending or really curtailing that oil production in Iran. So that's that's back to the multipolar world. If that were to happen, if Israel were to strike, then you're going to see oil up $10, $20 and then you're going to have a real bounce in inflation. Then the Fed's going to be forced to hold down interest rates because remember, interest on the debt now, because interest rates are so high, is $1.1 trillion, $1.1 trillion, up from $250 billion, 3 or 4 years ago. So the Fed is starting to cut rates because they know if you're the front end of the curve, your interest costs are $1.1 trillion. That is, really crowding out a lot of government expenditures. So the Fed's going to be forced in the next 2 years because of this multipolar world, commodity prices. The Fed's going to be forced to come in and kind of support the bond market, and that's going to create a real historic rush into hard assets and commodities.
And so if I understand you correctly, you think inflation might be subdued for now, but come 2025, it's going to accelerate again, and the Fed's going to be forced to act. They're not going to be able to cut interest rates in the face of higher inflation. They might even increase interest rates. What do you think of that scenario?
Yeah, so think of what just happened. The Fed just cut interest rates before an election with Atlanta Fed GDP at 3.3, 3.5%. That is just madness, right? And so we're cutting interest rates with higher oil prices. I mean, oil prices are bouncing. What we call, every economist on the street is talking about how strong the economy is. We've got a China fiscal stimulus that is a big surprise. We have almost a $2 trillion deficit in Washington that is up. We're up. The CBO told us 9 months ago, we were going to be like $1.4 trillion deficit this year. Now we're coming in, 1.8 to 2 trillion. And so we've got this massive fiscal overdose. You've got a huge fiscal and monetary stimulus coming from China. We've got tensions in the Middle East with oil prices. The probability of a really sharp bounce in inflation, I think, is almost certain, and that gets you back to a more hawkish Fed sometime in the next year. But once again, the Fed can't stay here. This is where I'm getting. If the Fed stays higher for longer to try to kill inflation, interest costs are 1.1 trillion a year, up from 250 billion. So they need to get the front end down to lower those interest costs on T-bills. Right now, the average, here's an amazing stat. So picture in your mind, 35 trillion of debt in the United States, 35 trillion of debt. 15 trillion of that rolls over in 2024, 25, 26. So the United States, 35 trillion of debt, 15 of that rolls over in 24, 25, 26. The average weighted coupon on the U.S. debt load is 2.5, 2.6%. Think about that, 2.5, 2.6. That means if the Fed really goes higher for longer and hikes rates again or threatens to hike, that means that that average weighted coupon, because that 15 trillion is rolling over, and it goes from 2.6% to maybe 3-4. That means your interest on the debt's going to go from 1.1, 1.2 up to 1.5 trillion dollars. And then you're into a real Liz Truss moment in the United States, which probably happens the first quarter of next year.
Interesting. And if this scenario plays out the way you envision, what does this do to the S&P? The S&P continues to make new highs every other day. Where do you see the S&P going?
Well, the S&P, the Trump administration, think of the 2016 election. So the S&P was down 4% into the Trump win, and it was flat for 18 months before. So think of 2016. We were flat for 18 months, and we were down 4% from the summer into November. Here, the S&P is up year over year, almost 46%. So we're up 46% into the election. And so what's happening is, you can see in a lot of these Trump trades, you can see in the regional banks, a lot of these Trump trades are up a lot. And so the markets this time around is pricing in a Trump victory of some kind. And so because of that, and because of the fact that we're running into this fiscal crisis in the first quarter, if Trump wins, he's going to most likely take the pain similar to what Reagan did. So when Reagan did in this kind of same environment, inflation, he took the pain early, and there was some really tough period. Reagan was elected 1980, 81 was tough, 82 was tough. But by 83, 84, they took the pain, and Reagan was able to be reelected almost in a landslide against Mondale in 1984. And it's a very similar situation where, because the Biden team, like I said, they want to win the election, so they've juiced fiscal almost up to $2 trillion a year with rate cuts, with a China stimulus, with higher energy prices and problems in the Middle East. All of that feeds into the sustained inflation. Trump will try to do something in the new year to handle this crisis. We have a real crisis coming in the first quarter. So stocks get hammered between now and, say, April. But then over the course of the Trump administration, most likely there's a deregulatory regime. There's a tax. I don't think they're going to get away with the tax cuts with a $35 trillion debt hole. But overall, there's a much more favorable backdrop to Trump over the course of the entire 4 years of administration. So you could have a big move down and a big move back up. If Kamala wins, the problem is, and here's the thing: if you're watching us right now, if Kamala Harris wins and she doesn't have the House and the Senate, especially the House, then it's a big fiscal cliff, because the Republicans will really enforce austerity onto her. And it's not fair. And it's just classic. Like, all of a sudden, the Tea Party people are going to come back. But you saw this week, Paul Tudor Jones. It's one person after another is talking about this reckless, unsustainable fiscal path in Washington, and it's Republicans and Democrats, right? But Kevin McCarthy literally pushed forward this debt ceiling agreement to late in the summer of 2022. That expires in the first quarter of next year. And so we're going to have, there's no question, if Kamala Harris wins and she doesn't have the House and Senate, which is, I think, likely if she wins, then you're talking about a huge fiscal cliff. And all that means is when you're doing $2 trillion deficits every year, and all of a sudden the House forces you back to 800 billion, there's a massive amount of fiscal cut in spending. And that's a big hit to the economy in the short term, and that creates a big downdraft.
In Q1 and Q2 of this year, there was this ongoing debate whether or not the U.S. was going to go into a recession. Now we don't hear anyone talk about it. The economy continues to be very strong. Unemployment, for the most part, is still at a decent level. S&P and the NASDAQ continue to go higher. What are your thoughts?
Well, see, that's exactly my point, is that the team Biden, this has happened twice now in the last 4 years. There was an inflation scare in 2022 in October. And then there was also a recession scare in 2022 in October, recession. And then we had a recession scare in 2023 with the banking crisis. In both of those instances, both times, the fiscal and monetary response was strong. And that's why the fiscal and monetary response to COVID plus the banking crisis and plus the economic shock of 22 has been $16 trillion versus $4 trillion after Lehman. And so that's what I mean is like they've done everything they can to prevent the recession. And you're absolutely right. Like recession probability in the first quarter was rising. They juiced fiscal and they did whatever they could to get us through the election without a recession. But that's creating all this sustained inflation. And it's like this massive, like a cocktail kind of a recipe for a new inflationary regime.
Quite often when we get a significant correction or crash in the markets, it's because of something no one saw coming. It's like getting broadsided going through an intersection. And you lived through the 08-09 great financial crisis. And during that time period in 2007, it was the collapse of a Bear Stearns high-grade structured credit fund, a couple of funds that no one even heard of. They were relatively small too, but that was really the first sign that there was trouble coming. Do you think there could be another potential black swan event happening right now? And if so, what would it be?
Well, in private credit, it's a real mystery meat sandwich where if rates are low, there's a lot of private credit, private equity, private transactions that have been done in the last like 5 years that were done at really horrible prices. And same thing in commercial real estate. But as the Fed's promised to cut rates, and they cut rates 50 basis points, I think the Fed knows this, by the way. I think it's very obvious the Fed is worried about a crisis there. That's why they're starting to cut. But if inflation doesn't allow the Fed to cut anymore, and if inflation keeps rates up here, you're going to have a big default cycle in private credit, and potentially that's going to leak over to public credit as well. So your private credit, so you want to look at your Blackstones, your what we call the business development companies. You want to look at those stocks because they're great. They're going to be great canaries in the coal mines because if there's a problem in private credit, it'll show up there first. But I think that's like when you talk to it, like I said, most of our clients are institutional investors, and you talk to them about where there's an old saying we talk about in my first book, and Buffett's famous for this statement, but he calls it mark to model, and then it starts with mark to market. So most public companies have to mark and most banks have to mark their bonds or their assets to market. When a company gets a little leeway on that in an illiquid place like CLOs or something like that, collateralized loan obligations, they can mark to model. So you mark to market, mark to model, and then the last stage is mark to myth. So it's the 3 M's, and that's where private credit is right now. If you talk to anybody that really knows anything about credit markets, I think 40%, 30% of the private credit market is marked to myth, and that's where you got a real nasty crisis that's out there if the Fed can't get rates down. The Fed needs to get rates down 100 basis points in the next year, or there's a massive credit crisis.
So in summary, it sounds like you're expecting a very tumultuous 2025. Maybe you can just wrap up for us how investors should be positioning themselves going into 2025?
Well, just think of, like I said, hard assets of value. Like the commodity space has been destroyed since, going back to 2011. Say the ratio of, say, the Dow Jones Industrial Average versus, say, just gold, to keep it simple. It's now 16, almost 16 to 1. So the Dow versus gold. That's probably going to come down. Historically, that should come in the 80s. It reached almost 1 to 1, right? So we're not going to get there. But does that come down to 8 to 1, 5 to 1? Yeah. So your stocks, which are financial assets, versus hard assets. So you want to be in silver, platinum, palladium, companies that own large reservoirs of commodities, BHP, Rio Tinto, Vale. You want to own companies that own large quantities of metals and oil and gas. Companies like Occidental Petroleum. Buffett owns he owns 80,000 shares, 80 million shares above where the stock is today. We've calculated because you've got a lot of tax loss selling there, as I mentioned earlier. And so you can buy companies. We're still going to have a drawdown in the market, but I think the major part of the market that gets hurt are what we call financial assets, and the companies that don't necessarily own large quantities of hard assets.
Well, that was a great conversation, Larry. And as we wrap up, maybe you can just tell us you've been on the road marketing your new book. Where are you going to be in the coming weeks?
We're heading to Austin, Texas for a nice, what we call a roundtable book signing. And then we're doing an ideas dinner in Dallas with Texas Capital Bank. It's been really what a great bank in the Midwest. And those are the two next ones. And then we're off to Miami in November, the 19th. We'll be there with John Najarian and I think Grant Cardone and that crew. And so it's Austin in early November, and then Dallas early November, and then on the 19th, we'll be out to Miami.
So you interviewed many people for this new book, How to Listen When Markets Speak. Was there one or two people that you enjoyed speaking with the most?
Well, Charlie Munger was amazing. I sat down with him in Omaha. Mark Cuban was really helpful. Mark has really helped me over the years. He's really thinks a different way around technology companies and sustainable technologies. And then obviously David Einhorn, legendary investor, value investor, David Tepper. Those are the ones that were just, really incredible support. Mike Alkin, we sat down with Mike in the uranium space, Sachem Cove, and he really helped us on that side. And then we sat down with Adrian Day on the metal side. With Adrian really got us very long. A lot of these silver miners, silver and gold miners, which if you look at the ratio of say, gold miners to the metal, those ratios are starting to break out again. So Adrian's point is we're really in the early innings of a move there, and that's all in our book, How to Listen When Markets Speak.
Well, once again, that was a fascinating discussion, Larry, and I want to thank you for making time today.
Thanks for thinking of us, and we'll see you at the top.
Thanks for watching, everybody. You've been watching Jimmy interview Larry McDonald about his book, How to Listen When the Market Speaks. And we thought this would be a great opportunity to bring in Brett Rentemeester from our partner, RIA WindRock Wealth. Brett, thanks for joining me. And we're going to talk a little bit about what Larry spoke about. Now, Jimmy had asked him about what investors that he speaks to are concerned with. I'm wondering, after watching the clip, if you're finding the same thing about what investors are concerned with today.
I mean, generally, yes, Andrew. From the perspective of there's a great unrest right now. Yes, stocks, markets are up tremendously, but under the hood of that is, a great concern about policy. And, I think when we talk to investors, there's probably 4 or 5 things they bring up. The main issue has to do with spending, debt, and money printing. People aren't stupid, and they generally know that there's a price to pay for printing money out of thin air and overspending and not having reasonable budgets. Now, that doesn't happen immediately, but that price over time is inflation, higher interest rates, and even a devaluation of the currency. So the currency is also on people's minds, the US dollar, both from that perspective, but also as we kind of face a growing BRICS coalition looking to get away from a dollar-centric world. And then two other factors, we're in one of the most overvalued stock markets on paper. So that's in people's consciousness. And then finally, and maybe most importantly, I'd say a period of political and institutional instability. The segment before was talking about a book, The Fourth Turning, which I brought off my shelf, one of my favorites. But the insight is that at a fourth turning or a crisis period in history, people lose faith in the institutions that they accepted in the past. So, I think we're looking towards those kind of issues ahead.
Now, he also talks about the period the period we're in now is kind of echoing the period from 1968 to 1981. You and I did an interview about a paper you wrote about 1974. So tell us about what you're finding about this period compared to back then.
Yeah, we did. It was called Echoes of 1974 and can be found on our website. But I would concur with a lot of his thoughts. Now, of course, no two periods are the same. The world was very different then versus now. But we had essentially 5 lessons from the 1970s that I think should still resonate with people today. And if you think about that period, 1968 to 1981, it started as a period of low inflation, and we ended with, almost 14% or higher, actually 16.5% short-term rates by 1980. So let me just list the 5 lessons. One was that inflation and interest rates, although they're volatile, they were upward trending and they went in a wave. They weren't straight line. People thought inflation was maybe okay, and then it came back. So, I think we're probably heading down that path once again. The second was that anytime you have extreme market valuations, you're going to have a period of pain at some point. Back then, it was the Nifty 50 stocks that in 1974 lost over half of their value. Today, it's AI and other things people are excited about on the technology front. The third lesson was anytime you have political instability rising, you have a loss of faith in government. Back then, it was Nixon and Watergate. Today, I don't even need to go into all the political instability we're talking about around the country. The fourth, and again, a mirror of today, was called war energy in the Middle East. So we're kind of back to that same dilemma and instability in the Middle East. And then finally, on a longer term basis, was the insight that there's a changing of guard in currencies about every 100 years or so across the world. Now, that period back in 1971 was important because that's when Nixon officially took us off convertibility to gold. Since then, we've been running in a different kind of world with really no regard for currencies tied to something of real value. So, the question is, from this point forward, what lies ahead for the dollar?
Brett, in his book, Larry also, and in his discussion with James, he also spoke about the positioning of our portfolios and how right now they're sort of geared towards 2010 to 2020, but they're not evolving, I guess, the way they should. Is this something you agree with? Or do we need to revamp the way we look at our portfolios?
I think we do. I think we need to rethink the wisdom of kind of the conventional 60-40 portfolio or stock and bond mix. Both have pretty tremendous headwinds going forward. For stocks, the headwind is overvalued prices. So even if a company delivers on the promise, are they just overpriced enough to not really make money? For bonds, it's really about interest rates. So if interest rates rise, that's a major headwind to bonds, and you end up losing value over time. So I think, again, taking some of the lessons from prior periods, mainly the 1970s, if you have a scenario of overvaluation where interest rates are rising, that tends to hurt most stocks and bonds together. Now, we saw that back in 2022, which was one of the worst markets on record for U.S. investors when stocks and bonds both fell together. People are used to them behaving differently, but that wasn't the case. So, our guidance is, hey, we live in the world we live in, so you've got to have one foot in the current system. So you probably are going to have some stocks and bonds. But on the stock side, you should be hedged. You should be more in value names, hard assets, energy infrastructure, like master limited partnerships are an area we've had a lot of success with. On the bond side, you should probably be thinking about interest rate risk. So maybe short-term treasuries are a good place to hold out. But outside of that, the foot outside of the system would be thinking about what could go wrong in the world. And with that mindset, I think you want to consider precious metals, both gold and silver. I think there are a lot of other hard assets that tend to do well in trying times. And there's some unique niches like build-to-rent real estate that you and I spoke about that, as it gets more unaffordable for people to buy their first home, people are choosing to rent, but they want to do it in a more home-like, system. And then finally, cryptocurrency, still a wild card, but something that investors should consider as the world keeps printing money out of thin air.
And WindRock is innovative in that way. You look at alternative investments and not just equities or bonds and stuff like that, right?
That's right. I mean, it's a big part of what we do. And honestly, I think it's why clients end up finding us, because they want someone bringing them ideas and not giving them what worked yesterday, but more of a list of things that are likely to succeed, under the conditions we laid out here.
Yeah. So if you're looking for help being financially stable and keeping it that way, given the uncertain economic times, you can head over to wealthion.com/free and you'll find WindRock. You can head over to windrockwealth.com and find Brett and his partners, and they'll certainly be able to help you out and point you in the right direction. That's for sure. I mean, that's why we partnered with you and we trust you, and you've done a great job for us. But we'll do this from time to time. We'll have Brett and his partner Chris and Brandy on to try and give some perspective onto what some of our other guests are talking about. So Brett, thanks so much for joining me. I really appreciate it.
Thank you.
Well, I hope you enjoyed that discussion with Larry McDonald, and it gave you some insights on what to expect here in the coming months. It sounds like 2025 might be a tumultuous year. We all need help when it comes to planning and preparing for our financial future. And if you have a financial advisor and you're happy with them, then great, stick with them. But if you don't, or maybe you want another opinion, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com/free. It's a free service that Wealthion offers to anyone who has an interest, and there's no obligation on your part. You can find out more information at wealthion.com/free. If you like this content, please subscribe and like and share. And if you want to check out some more content, check out this video now.